This is Financial Accounting, and I'm Dr. Baldwin. This is the second lecture on Chapter 2. This lecture mostly concerns the recording of transactions in journal entries. First, let's briefly review some concepts you learned in the first lecture on this chapter. Let's review our previous summary slide. In the accounting process, you first analyze a transaction by looking at the source documentation. Next, we apply the rules of double entry accounting and record a general journal entry. The general journal is a chronological listing of the transactions. At the end of the accounting period, we post the information from the general journal to the proper general ledger account. The general ledger groups all the transactions that impact a particular account together in one place. That is, all the transactions that increase or decrease a particular account, such as the cash account, are posted to the cash general ledger account. Of course, there's a fifth step, and what is the fifth step? The fifth step is we make a trial balance. And that was also mentioned in the previous lecture. How are we going to record these business activities? We're going to make journal entries. So the rest of this lecture is about journal entries and some other stuff. Yes, really journal entries. We actually can't use T accounts to make all of the journal entries like sort of implied in the previous lecture, because even though they're useful for illustrating the concepts, if we have thousands or even hundreds of transactions for which we need to record journal entries, then we have to do that in a journal, whether it's a paper-based journal or electronic journal. We can't do that directly in T accounts. Here's an example of the proper recording of a general journal transaction. We've seen a similar transaction before. In this case, the owner of the business contributes $30,000 cash to start the business and receives shares of common stock in return. Let's see how we get the various pieces. Part 1, the transaction occurred on December 1, 2011. The date is important when recording general journal transactions, and it's recorded in the left side of the journal. So the first thing you see there is the date. Part 2. Next, we identify the accounts affected by the transactions. The cash account is an asset that has increased. We show increases in accounts like cash asset accounts with a debit to that account. The common stock account also increased, and we show increases in equity accounts with a credit. Debits are always listed first in the journal, followed by the credits. And you can see that the credits are slightly indented below the debits. So there's a little space here. We indent them. If we had several, we would have them the same level of indentation here. We list the debits first, then we list the credited accounts. Part 3 is the dollar amount. The dollar amount is placed in the appropriate column for debit or credit. In this case, the cash account was debited for $30,000. That's an increase of an asset known as cash, and we place that amount in the debit column. We recorded the existence of the common stock by the $30,000 credit in the credit column. Finally, we prepare a brief description, just has to be one little line there, of the transaction so that other people who view our work will understand the nature of the transaction. This explanation is indented about as far as the credited account titles, just to avoid confusing it with the accounts, and it's usually italicized. If you're doing this by hand, some people will write this in longhand or cursive just so it'll be obvious that it's not an account, it's an explanation. Here is the balance column account for cash. All right, this is just cash. You can see cash in the upper left-hand corner. It looks similar to your checkbook. We have a debit or an increase column because for cash or any asset, the debit column is the increase column, right? We have a credit or decrease column, and we have a running balance. You can see the cash receipts and the cash payments. Cash coming in, there's two places there where cash comes in, and cash going out. There's two places there with the credits where cash is going out. We want to be very careful that we assign account numbers to our accounts, and you can see that in the upper right-hand corner. This is account number 101. We talked about the numbers, the numbering of accounts in the previous lecture. When we speak of account number 101, we're referring to the cash account, and anybody who knows anything about accounting would know that in this particular company. Let's look at the posting process. We will transfer or post the information from the general journal to the proper ledger account. This process is called posting. Not exactly creative, is it? First, we find the proper account in the general ledger. In our example, we're using the cash account. So we found the page, if we're talking about a paper journal, for cash. We transfer the date, December 1st, to the date column in the general ledger. Then we place a description into the description column, the explanation column, and place the debit amount of $30,000 in the debit column of the cash general ledger account. So we'd write a little explanation here, investment by shareholders, and we place the amount, $30,000, in the debit column. Next, we indicate where you can find the journal entry. In this case, it happens to be in the general journal on page 1. So we put G for general journal and 1 for page 1. It's a pretty common thing to do. We're just referencing back and forth so we can tell what's happening. Now we update the running balance of the cash account. Well, that's pretty easy to do since this is the first entry we've made, but you can see the running balance down here in the right hand column right here. Back in the general journal, we enter a posting reference. Remember, we entered one here that said, hey, this came from general journal page 1. Well, back in the general journal, we're entering this account number from the ledger. So that's going to be our reference back. This tells the accountant that the account has been posted to account number 101. Now we can go back and forth between the general journal and the general ledger. This is known as a cross-reference. We would follow the same procedures for the common stock account. Let's begin using double entry accounting now. Let's see if we can analyze the transactions and get them into the proper form for double entry accounting. This will be helpful when you turn to your homework. In the first transaction on December 1st, Chris Taylor invests $30,000 to start a company called Fast Forward. From our previous work, we know that the cash account and the common stock account will both increase. We record this information in the general journal with a debit, an increase to cash, and with a credit, an increase to common stock. Notice that the account number for the cash account is 101 and for common stock is 301. We're going to post the information in the journal to the general ledger. We'll use T accounts to accomplish this. So here are T accounts at the bottom. This way we can make it all fit on one page. We place the $30,000 on the left or debit side of the cash account, and we place the $30,000 on the right of the common stock account on the credit side. Our books are in balance because total assets equals total liabilities plus equities, right? Liabilities are still zero. Let's move on to another transaction. In our second transaction, Fast Forward purchases office supplies paying $2,500 cash. We've exchanged one asset, cash, for another asset, supplies. The cash account will decrease and the supplies account will increase. Can you make the journal entry to record this transaction? What did you do? We increase the supplies account. Remember, that's an asset. Assets increase with debits. So we debit the supplies account by $2,500. We credit or decrease the cash account. It's an asset. So we increase it with debits, decrease it with credits. In this case, we're decreasing it. We credit the cash account for $2,500. Now, let's post the amounts to our T accounts. The general ledger account for supplies is increased by $2,500, so the amount is placed on the debit side. Remember, supplies is an asset, so we increase it with a debit. The cash account, which also happens to be an asset, is decreased by $2,500. So if we're going to decrease an asset, we have to do the opposite. We have to place the amount on the credit side of the general ledger account. Let's move on to another transaction. In our third transaction, Fast Forward purchases equipment paying $26,000 cash. Wow, lots of money. Once again, we have exchanged one asset, cash, for another asset, equipment. The cash account will decrease and the equipment account will increase. This general journal entry will look similar to the one we just completed. So we debit equipment for $26,000 and we credit cash for $26,000. We've exchanged cash in order to get equipment, one asset for another. The general ledger account for equipment is increased by $26,000, so it's placed on the debit side. The cash account, an asset, is decreased by $26,000, so the amount is placed on the credit side of the general ledger account. Let's look at another transaction. In this transaction, Fast Forward purchases $7,100 of office supplies on account. The supplies account, an asset, will increase, and the liability account, accounts payable, will increase. So we have a liability now called accounts payable. Let's make the general journal entry. So we're getting kind of used to this increasing assets thing. So here's our debit to the supplies account. That's an asset account. We increase it with a debit, so our debit is $7,100. We also have to increase the liability account, accounts payable. We do that with a credit. Notice that liabilities are on the right side, or the credit side of the equal sign. That helps us remember that if we're going to increase a liability, we're going to do it with a credit. Now let's post the transaction. The general ledger account for supplies increased by $7,100, so the amount is placed in the debit side of that account. The accounts payable account, a liability, increased by the same amount, so we place it on the credit side of the general ledger account. Now let's analyze yet another transaction. In this transaction, Fast Forward provided consulting services and collected $4,200 cash. The asset account cash increased by $4,200, and the equity account consulting revenue, so there's a new one, we've got a revenue account now, increased by $4,200, the same amount. See if you can make the general journal entry to record this transaction before we move on. So, what did you debit? Did you debit cash? Because cash is coming in. We've been paid cash into the company by our customers. So we've debited cash, an asset, which is being increased by $4,200. We have credited consulting revenue, that's a revenue account, by $4,200. Remember, that's an equity account, and revenue increases equity, so it does the same thing. It's on the same side as equity is of the equal sign, so to increase it, we're going to credit it. So let's post them to the T accounts. I'm getting pretty good at this by now. So here's our credit to consulting revenue. Here's our debit to cash. These are just our T accounts as we're posting. Now, we could do a whole lot more transactions here, but your homework is going to reinforce what we're doing here. So I'm not going to do a bazillion more transactions, but you're going to get a lot of practice. You're going to have a lot of homework using journal entries, and you need to do it all, and then you probably need to do some more for practice. Seriously. On the trial balance, we list all the accounts in our general ledger. So we have a particular point in time. Now let's assume we're at the end of the month and we've processed all the remaining transactions for December. Right? Obviously there were more than 4, but let's assume we processed them all. And now we've collected all of the balances from our general ledger. So we have all the accounts that have balances, and we have listed them with their balances, whether they're a debit or a credit. We've listed them in the appropriate column. Notice that the total of all the debit account balances must equal all our credit account balances. If this is not a case, we may have made an error in posting the journal entry into the ledger. We cannot prepare the financial statements until the books are in balance as determined by the trial balance. So you can see here, our trial balance is balanced. Here are 6 steps for searching for and correcting errors. Put a big star or a big highlighted asterisk or something on this slide in your notes. I know you're taking notes, right? We've talked about that before. So on your notes, put a big star by this one, because if you find you have trouble with your homework in making your trial balances, this is a good slide to refer back to and to help you solve those problems. Here are 6 steps to follow when your trial balance is out of balance. First of all, verify that the trial balance columns are correctly added. Maybe you just punched it into the calculator wrong. That's not an uncommon error, right? Especially if you're doing it in a hurry. Number 2, verify that the account balances are correctly entered from the ledger, so you have to trace back a step. And then 3, see whether a debit or a credit balance has mistakenly been listed as the opposite. All right, you want to make sure you got them in the right column, particularly when you're going to the trial balance from the ledger or going to the ledger from the journal. Number 4, if you need to, recompute every account balance in the ledger. Number 5, verify that each journal entry is properly posted. So we're going all the way back to the journal and making sure that we went from the journal to the ledger appropriately. And number 6, verify that each original journal entry has equal debits and credits. You're sort of going further and further back looking for the error. As we have seen in the last chapter, after the trial balance has been prepared, we begin preparing the financial statements. We always begin with the income statement because net income appears on the statement of retained earnings. So we have to know net income before we can make the statement of retained earnings. So after the income statement, we prepare that statement of retained earnings because the ending balance in retained earnings appears on the balance sheet. So we have to do that before we can prepare the balance sheet. Next, we prepare the balance sheet. So it's income statement, then statement of retained earnings, then the balance sheet, right? Also, we can talk about doing the statement of cash flows, but we're going to blow right by that one for now. We'll talk about that in a later chapter in more detail. So using the trial balance that we have for Fast Forward, here's our income statement. You can see we have consulting revenue. We also have some rental revenue for our total revenues of $6,100. You can see that we have our expenses listed and we total them up, and then we have the difference between these. It happens to be positive because our revenues exceed our expenses, is $3,470. Let me talk a little bit about formatting here. I mentioned before in a previous lecture that you always have a heading. They're pretty obvious in these slides because they're all purple. Name of the company, name of whatever the financial statement is, and then for most of the financial statements, all of them except the balance sheet, it will say for the whatever the period is, in this case it's month, ended, and the date it ended. So for the month ended December 31, 2011. You're going to see an appropriate heading on every statement, and you need to put appropriate headings on your statements. The other things you're going to see are how we format what we're doing. You can see we've used 2 columns here. The 2 columns are where we need to know all the revenue, so we've done the intermediate calculation in the previous column. We need to know the total expenses. We've done the intermediate calculation in the previous column. You'll also notice that we only have dollar signs on the first item in a column. Personally, I would have put one here as well for salaries expense. Once you are going to get a subtotal or a total, you draw a line under the last one, and since we're using 2 columns, we put the total over here. It happens to be the total revenues, the first number in this column, so we put a dollar sign on it. You'll notice we don't put a dollar sign on the next one. We assume that everything between there and the next single line are dollars. We don't have to put a dollar signs on it. So every time you start a new column, put a dollar sign. Like I said, I would have put one right here as well for salaries expense. And then, of course, whenever you have a total or a subtotal, put a dollar sign. Now, of course, if we were doing euros, you'd put a euro sign, but we're going to do dollars. You'll notice also a double underline. A double underline says we're finished. This is our final total for whatever report or statement this is. So we've double underlined our net income. If you look back at the trial balance, you can verify all the accounts on this income statement. I can't really show you this that easily on the slides, but you can lay them out. You've printed them out to make notes, right? So you can lay them out and you can look at all of them at one time. Now, let's make our statement of retained earnings. The beginning balance in retained earnings is 0 because the company was started on December 1, 2011, right? It just started. There was 0 at the beginning of the month. We earned income of $3,470. We just saw that in the income statement. That comes from the income statement. We also had another transaction this month in the many transactions that I didn't demonstrate where dividends were paid out to the owner. So we have to subtract the dividends from this intermediate subtotal in order to get the balance. So you'll also notice I've left off the dollar sign. I think should be right here. Every time we draw a line and we have a subtotal or a total, put a dollar sign. The intermediate numbers, they don't need a dollar sign. Why is this 200 in parentheses because we're subtracting. Dividends decrease retained earnings, right? So our total retained earnings at the end of the month is $200 less because we paid some of those earnings out. We didn't retain those $200. We paid them out to the owner. So now we know the balance in retained earnings. This amount is going to appear on the balance sheet. This amount right here, $32.70, is going to appear on the balance sheet in the equity section. Now let's look at the balance sheet. So here's our balance sheet. We're going to take that $32.70 and it's going to show up down here in the equity section. But let's look at what we have. We have all of our assets. These are the balances, the debit balances, and all of those asset accounts straight off the trial balance, and we've totaled them up. And they've totaled to $42,470. We have all of these liabilities. There's only two. We've totaled them up. If it were me, I would put a $sign there. Then we are going to get totals for the equity accounts. So here's our total equity. We take our total liabilities and our total equity, we add them up, and that gives us our total for liabilities and equity. Notice that the total for liabilities and equity is equal to the total for assets. Our balance sheet is in balance, as well it should be. This is the end of this particular lecture video, but you may want to watch it again, or you may want to go back and watch a piece of it. But what you're really going to need to do is practice your journal entries. Your next homework assignment for the second half of this chapter is full of journal entries. There's also some making of financial statements and trial balances, but it's chock full of journal entries. So you want to practice. The other thing is this homework is going to take a good bit of time, so don't leave it until the last minute, the hour before it's due. There's no way you'll get it done. It'll take several hours. You also, ideally, don't want to do it all in one sitting because you're going to be exhausted. You shouldn't do that for any class if you can help it. So spread it out. Work on it for 30 or 40 or 45 minutes, whatever you have, and then take a break and do something else. Work on a different class, go to work if you have a job, do whatever you've got to do, and then come back and work on it for another block of time. Spread it out. Remember that the due dates on your schedule are due by dates, not do it on dates. You can do them anytime before that. Anytime they're available to you, you can do them. You don't have to do them on that date. That's just the last possible date you can get credit for it. All right? Go work on your homework. And if you have any questions at all, email me immediately and I'll do my best to answer quickly.